Welcome to TheoTrade. This is Don Kaufman. It's April 2nd, 2018, coming out of the holiday weekend into a bang. The S&P futures, Nasdaq futures, Dow, Russell, I got to tell you, across the board, surprised me as a trader. Let's get into it and first and foremost break down some of the levels and key kind of inflection points that we hit throughout today's trading session. First and foremost, what I'm zooming into right now happens to be specific to the S&P futures. I recognize that many of you do not necessarily trade the S&P futures, but it is imperative to understand these futures, people, they drive order flow to the marketplace. And it is imperative that we understand, okay, what these levels really mean, these tranches, if you will. All right, this happens to be the cash open. We rallied up, faded. The first level we hit, and we've been talking about this now for weeks, happens to be 26.26. Not only did we sit at the level, okay, for a period of about 20 minutes, but breaking off that level was met by extreme volume. All right, we broke away, and I got to tell you, the break that really surprised me was from this level of just shy of 2,600. We ultimately shot down in a period of about, right in here is a period of about 10 minutes where the S&Ps lost 25 handles. And we actually came down to our next level on the screen, which happens to be 25.75. All right, so these are two key inflection points that we've been mentioning kind of week in, week out, day in and day out on these videos. We hit both of them. Ironically, that's pretty much where the markets close. Now, the S&Ps are still open for about 15 minutes after the cash market closes. It would not surprise me to see us drift right back into 25.75, which is kind of the happy place, if you will, for the S&Ps. So before I go any further, and we're going to look, again, into the future of what we can expect in markets here. Before I go any further, I want to talk just a brief bit about these levels because, you know, I guess the biggest question I'm getting right now is, hey, you know, Don, if we break below 25.75, where are we headed? And I got to go. Listen, quite frankly, I don't have any levels below that. All right, we can open up a time frame here. Instead of 30 days, I'll even open up 90 days and snap this to the 4 hour and hit OK, right? And you can see, again, I've picked up on these levels time and again. But we were initially looking at the 25.75 level all the way back here in late November, and that's ultimately where we're now back to. So first and foremost, I would have to assume that any break to the downside, we would be retesting some of the lows from early February. Okay, but people, come on, that's an easy target. You know, oh, we're going to retest some lows. Retest them? What happens if we start cresting through them? And that's where I got to say, all right, there is nothing but downside in this marketplace. If you then break out the time frame, I'll break out the time frame then, even out to 180 days, all right, 4 hours, hit OK, and you start to get a little bit of a larger picture. Breaking below, again, even the 2,500 level, markets could literally go into a free fall for a bit of time. However, I don't necessarily expect this to play out that way. But it's important for me to kind of distinguish to you that I do not have any specific levels currently below this 25.75. From there, again, it really is a bit of a free-for-all to the downside. Now, there's one aspect that I want to focus on for just a moment. You're going to notice in days where the S&Ps are moving, for instance, 2.5%, or the Nasdaq is off by 3%, I'm less inclined to discuss individual stocks. I know you're going to turn on the media over there and they're going to be like, well, what about Amazon and the tweeting of Amazon? People, okay, it doesn't matter. So what? It's off 5%. Well, what about Intel? Intel got dumped by Apple today. Okay, so it's down some 6%. I'm going to tell you what really matters. And when I talked about, you know, right up front that we're looking at the S&P futures because the S&P futures drive order flow to the marketplace. And why do I look at the S&P futures? Why do I look at the Nasdaq futures in the midst of some volatility? Because individual stocks simply don't matter. Okay, how could I possibly say that? Well, here, this is the S&P 100. And I want to qualify that statement. This is the S&P 100. There's just nowhere to hide. That is sell-side activity. And I'll tell you, a few of the underlyings that were to the upside in today's trading session had news. There is announcements in here. In the S&P 100, that's as close to full-blown correlation as we get. When I talk about correlation, what that effectively means is, okay, listen, every product is correlated with the S&P futures. Now, that's the S&P 100. Well, that's not fair. Let's cruise over to the S&P 500. Well, the S&P 500, I got to tell you, okay, that ain't much better. You have 485 products trading to the downside today. And again, the handful of products that are up were likely news and event related. All right. The same, of course, is true of the Nasdaq 100. So what's imperative to understand is that when you're moving through more volatile periods of time, okay, and we're not per se in a bullish market anymore. For right now, we're going to call it a volatile market. Stop thinking about individual stops. Stop thinking about what you believe Apple is going to do. Okay. Stop thinking about, well, you know, the news on Amazon. Nothing matters at this point. If the S&Ps sell off, okay, then we're all going down. If the S&Ps decide to rally back up to 26, right, you're going to need an explosive move in every product, all right, in the marketplace. And that's one of the things, again, that I want you to focus on. Now, what else is important in today's trade? Let's look at the volatility and the volatility futures for just a brief moment, because we are still in a pretty wild backwardation. And what this kind of entails is short-term volatility, 16-day volatility is really far exceeding, okay, 44-day volatility. And then some. This is actually one of the larger backwardations that we've seen in quite some time. And what this, again, effectively means is we are in the pit, the middle, if you will, of heavy amounts of risk. They're saying in the next 16 days, we're going to be considerably more volatile than in the next 44 days. And that's why we drop into what we term backwardation. If you scroll out a little bit in time, we can even compare, right, 44-day volatility futures. And I'm going to kind of highlight this on your screen for just a moment, but you can compare 44-day volatility futures all the way out to 170 days. And you're going to see the risk is still greater in 44 days than it is 170 days. So you start to get a feel of like, all right, it's serious out there. And that's exactly what I want you to get a feel for, not just because somebody says it or somebody points out some Fibonacci level, but because the volatility futures are real skin in the game marketplace. Listen, there's 82,000 contracts that traded of a wildly volatile product today. I mean, I'm going to trust 82,000 contracts well over what somebody might state as, you know, even a specific level, including me. Again, the S&Ps are likely to trade from kind of tranche to tranche. If they break below this 25.75, again, markets get extraordinarily dicey from there on out. Now, looking down the list, as I said, I wanted to explore a little bit more about volatility. The VVIX remains north of 110. That's indicative of kind of a duck and cover. But I also want to bring up one aspect that I brought up on the weekend video, and I'll kind of explain this in a little bit more depth, and that has to do with what we term expected move. So for those of you that have tuned in kind of week in and week out, or day in and day out, you'll know that I look at weekly expected moves inside of the SPX. Okay, and the weekly expected move this week, the irony of this week is we are expecting a move of plus 62, okay, or minus 62. Now, you're going to ask, of course, where did you come up with the $62? You can go to the Analyze tab, and this is specific to a tool on thinkorswim. The Analyze tab, I'll close up this left side bar. And on this Analyze tab, I am now in a feature called Think Back. It's just looking at end of day data. So I just jump back to this weekend's data. I just jump back to March 31st and pulled the expected move directly from the options chain, which was about $62 plus or minus. Now that $62 is based off of the option premiums within this chain. So all of the option premiums kind of averaged together within the chain using implied volatility come out to about an average of about $62 is what the market was anticipating the move to effectively be. If you cruise back over to the chart and you even look on an intraday basis, take a look. did we move inside of the $62 window? Now, I want to remind you, the $62, that's good for the entire week. We hit it today. We literally, okay, sold off, hit the expected move today, and closed almost spot on the edge of the expected move. So there's an interesting kind of correlation also. This week, the edge of the expected move happens to also correlate to right around 25.75 in the S&P futures. Okay, at this point, I think it's more coincidence than anything. But again, this level absolutely held. Why this is interesting, though, to me, and why am I explaining it? Again, thus far this year, we've only had 4 weeks where we stayed inside of an expected move. Now, I just want to, go through this example really quick because I had dozens of emails specifically about this. If you look at a distribution curve, okay, these little parentheses that I've drawn on the chart, that really is, okay, the distribution curve. We're supposed to stay in, if you will, the meat of this curve. We're supposed to stay in there about 68% of the time. That's about 1 standard deviation. But if you look at the beginning of this year, we just keep cracking outside and cracking outside and cracking outside the expected move. And right now, we're sitting at, 4 out of 13 weeks. 4 out of 13 weeks has been inside of the standard deviation. You start to look at the mathematics of that, you're like, wait, that's completely backwards. We're not staying inside the expected move 68% of the time. Okay, we're barely ever inside the expected move. Instead, we're cruising all the way out here in the curve. Again, if you were to look at a distribution curve and you think about all the occurrences that are supposed to happen in this range, the exact opposite is happening thus far this year. We're out here, okay? We're all over the place. And the reality of this, and the reason I'm bringing this to kind of fruition right now, is I've mentioned time and again, well, what's the difference over here? Who cares if we break outside of the expected move or not? I'll tell you who cares. Do you sell options premium? Do you? Have you ever thought about buying options premium or selling options premium? Okay, because the difference between being a buyer or a seller, it's everything, especially when we're cresting outside of the expected moves. Again, I'm just going to zoom into some blank space over here so you can see precisely what I happen to be referencing in this kind of instance. So if we look at a distribution curve, if you're selling options premium, most of the time you're selling options premium out here on the curve and you're hoping that we stay inside the curve, right? Well, right now, we're not staying inside the curve. We're just, ripping you apart if you're selling options premium. Yet, you're still seeing people step up to the plate and sell options premium. Why? Why do they sell options premium right now? Well, because the volatility index has been suppressed, and it's been suppressed. Look, over the last 3 years, we'll pull up a 3-year on here. This volatility index has been suppressed for such a long period of time. I mean, again, by the way, I don't think even 3 years does it justice. I think I can go to a 5-year, okay? And this is the first, persistent volatility period we've had. Oh, we had a little bit in the beginning of maybe 2016, but we've already gone past that kind of window in terms of volatility. So right now, we have all these traders, they're stepping up and selling premium, and they don't realize they're walking into this like lambs to the slaughter. They don't realize that the moves that the market is currently doing, right? Look, the actual move of the market, which is known as historical volatility. The historical volatility right now, whether you're looking at the SPX, whether you're looking at the Nasdaq, I don't care whether you're looking at Amazon, they're not doing a good job of handicapping risk. In fact, I can go as far to say as they're doing a terrible job. The marketplace right now is not doing a good job of handicapping risk. There's still a lot of people that are willing to sell premium, even though it's a losing proposition right now to be selling heavy amounts of premium. So time out. What is going to make this more appropriate? And that's where I keep mentioning this, and I'm going to say it again. Look for an extraordinary volatility shock. Something in a move that is so terrifying that it knocks every premium seller right now, not, and again, I'll explain this, but every premium seller out there right now knocks them so deep into a hole that they don't come out for another 18 months, okay? And then, and only then, does the volatility truly expand and the volatility expands, that's when we're going to start to step in with a heavy hand. Okay, a move so hideous that you can barely even quantify it. That is what we are going to need to see before I think that the marketplace truly corrects itself. Okay, again, in the duration, if you're looking at this, you're like, yeah, the volatility is back to like 25%. Yeah, 25% volatility. People, there was a point in time today where the Dow was facing what? A 1,000-point down move. We have 3% moves on the Nasdaq. We had 3% moves in the S&Ps, and we're looking at volatility and going, yeah, it's at 25%. 25% is nothing. 25%, that's 25% annualized. You're getting a 3% move in the marketplace today. What is wrong with people? Okay, you're selling yourself into an oblivion at this point. Okay, you have to go in, be constrained right now. Go in with what I call alligator arms, and that is very, very small contract size if you're going to sell premium. One last aspect, and I want to show you how, inefficient the market is right now. If you take a look at volatility, again, if we looked at it from this weekend, what was the expected move? It was $62. What's the expected move today? 65. The irony is we already moved $60 today. So over the weekend, the marketplace is saying, yeah, we're going to move $62. Was the marketplace right? No. We already moved $60 today. What is today? Today is Monday. We have another, 4 trading days left, and we're looking at another $65 move. All right, on a day-to-day basis, stop trying to anticipate what the markets are going to do. Understand that we're going to trade from tranche to tranche. I will spend as much time as I possibly can to pull more levels out for you. When I talk about those levels, again, those levels are going to pertain specifically to the S&P futures. It's no surprise we just saw the S&P futures close pretty much smack dab on, okay, our 25.75 level. You got to love it. If we start to break lower, I will try to fish out more levels for you. It can take time. It can be an arduous process, especially when we really don't and have not traded much in that area. I want to thank everybody for joining us here at TheoTrade. Join us live all throughout the course of this week in the TheoTrade chat room. Because people, we are expecting quite a bit of volatility. Have a great evening, everybody. Bye-bye.